Shares in the engine maker Rolls-Royce dropped the most in 4 months after swinging to a full-year loss of £2.9 billion in 2018 on the back of exceptional charges relating to problems with its Trent 1000 engines. Meanwhile, British Airways owner IAG jumped the most since November after adjusted operating profit beat analysts' forecasts. Joining me now to discuss the two stocks is AJ Bell's Investment Research Director, Russ Mould.
Hello, Victoria. How are you?
I'm good. Thanks so much for coming in. So should we start with Rolls-Royce?
Okay, let's get the difficult one out of the way first, shall we?
Exactly. So we had this big pre-tax loss. Clearly that's what's spooking investors. Does it remind you of what we saw back in 2016 when we had that historic loss?
It's similar but different in that Rolls-Royce has gone from a 4.6 billion loss to a 4.9 billion profit to a 2.1 billion loss. But it's not actually that much to do with the day-to-day operations. A lot of it is down to how they book their foreign exchange hedging, and they have to mark that to market on their balance sheet every year, and that knocks the profits. You've got huge swings. It's an accounting issue. It's not a cash issue. And that's why Chief Executive Warren East prefers to look at cash flow rather than these stated profits were affected by huge accounting issues, not how the company's doing day to day. So day to day, the profits are a bit better than expected. The cash flow was a bit better than expected. So underlying, they're nowhere near as dreadful as that £2.1 billion loss actually looks at first glance.
But the share price doesn't really seem to be interpreting it in that way because it was down considerably this morning. I mean, I think part of it is because of these exceptional charges relating to the engine issues around this Trent 1000 engine. I think it's for the Boeing 787 Dreamliner. How worried are we about that?
I think there are three issues with the engines which are genuinely worrying people, which are all about the day-to-day performance. You've got extra charges to cover costs of Trent 1000 engine problems. They're even now partly compensating airlines when the planes are stuck on the ground. You've got more charges for the Trent 900 engine, it's the same, and they've announced that they're not going to participate in a contest to try and win an engine designed for Boeing's next generation of mid-sized aircraft. So there's three issues on engines. Mr. East and his team, they're doing their best to fix those problems, but it's proving more expensive and taking longer than people thought. And the decision not to participate, saying, we just got enough on our plate as it is already. I think, again, that's another thing that's been taken as a slight negative today.
So Warren East, the CEO, is embarking, or has been embarking over the last year or so, in this major restructuring plan. We're seeing jobs being cut. We're seeing a slim down in the organisation. There was also the dividend that was cut several years ago. How would you say that that plan's going?
I think he's a very smart guy. Don't forget, he came from ARM, one of the UK's leading technology companies, which was then acquired by SoftBank of Japan. So he's a smart guy. He's inherited an extremely difficult situation, and I think given the hand he was dealt, he's doing really pretty well. The balance sheet's now net cash, so there's a huge cushion, safety cushion now behind the company. The accounts, which we've just discussed, are extremely difficult to interpret, but the fact that cash flow is improving, the balance sheet's improving, are good signs. It's just going to be a long haul, if you'll pardon the expression, in terms of getting the company performing to the level that it did several years ago. So, you know, I'm not allowed to invest my own money because I sit here chatting to you about subjects like this. If I was, I'd put it in the too difficult box for now. There are 2,000 companies quoted in the UK stock market alone. The accounts for an awful lot of them are a lot easier to understand than this. I'd be inclined just to sit and wait and see what Mr. East and his team get up to.
So one analyst team that might disagree with you there is the team from Credit Suisse that recently upgraded the stock from a hold to a buy. They say that the Trent issues are kind of
on the way
out, and they point to confidence in some of its other engines and suggest that it will be able to reach this free cash flow target
of £1 billion.
Of £1 billion by 2020. So do you think it's on track to get to that FCF cash?
To be fair, at the moment, the numbers today would say yes, actually. So long as they can keep the Trent engine situation under control, then the signs are very promising. And there are improvements. You are talking about the cost cuts, selling marine for business, for example. So it's focusing on its core competencies. I certainly wouldn't be running away from it. If I held it, I'd probably be sitting on it thinking, yeah, at the moment there are enough signs there to keep me interested. But you are looking at a stock that's trading on around 30 times earnings, albeit very depressed earnings, with a dividend yield of around 1.5%. It feels like it is going to be a long haul. You're going to have to be very, very patient.
All right, let's swap to IAG now, the owner of British Airways. It's having a considerably better day than Rolls-Royce today. Were you encouraged by the numbers this morning?
And the numbers were a bit better than expected, particularly for the fourth quarter. For the full year, sales were up 7%, profits were up 10%, to an all-time high for the company in its current format. Founded in 2011 through the merger between British Airways and Iberia, €3.2 billion of operating profit, is a phenomenal achievement, double-digit operating margins, so that's all good. Dividend increase and a 35 € special dividend. So on last year's numbers, the stock's yielding around 9.5%. Again, you can't pick too many holes in that. The shares they did, having gained initially, then lost a little bit of altitude, and the reason for that is the outline for 2019 from boss Willie Walsh, which is for basically flat profits. And a big issue there is fuel costs.
How do you think that this airline is managing to buck the trend of the broader sector? Because we've seen a number of the smaller airlines go bust. You pointed to in your notes the fact that in the US there have been a number of airlines that have come out with profit warnings recently. So what are they doing well?
I think they've driven their cost base down and managed their cost base incredibly well. They have increased capacity, but they've done it in a very controlled fashion. I think capacity was up around 6% last year, including Level, their new low-cost long-haul offering. So I think they've been very good on the cost side. I think the control of the supply and growth in supply has been good. And in the end, they're benefiting from the fact that some of their rivals are going out of business. So they're picking up trade from Monarch or Fly BMI or wherever it happens to be. So that has definitely been a plus for them. But like everybody else, they've got higher fuel costs to contend with. That's been a big problem for all airlines. And they are still in a very competitive market, even if some have fallen by the wayside. They've still got Ryanair to deal with, they've still got EasyJet to deal with, and they've got multiple other international competitors. So it's not an easy market. And with fuel going up, it's a quarter of their cost base. They've very little control over it. That's a big encumbrance for them in the coming year. Flat profits, all things being equal, at a record high for an industry that was famous for things going brilliantly or going badly and nowhere in between, is still good, but possibly not quite good enough to get the share price going today.
So for a company that's listed in the UK and Spain, it seems as though it's really in the crosshairs of the Brexit uncertainty. The CEO, Willie Walsh, said that he doesn't think that passenger numbers will be affected if there is a no-deal Brexit. I find that hard to believe. I want to get your view there.
I think I mean, the biggest complication for them is the Open Skies Agreement with the European Union. If the UK crashes out, if there's no deal, then in theory, UK-based airlines could lose their licence to fly certain routes between the UK and Europe or within Europe. So that...
Is that dependent on how many investors they have? I thought it was if they have 50% of EU investors, then they can maintain their flying rights.
They're currently at about 47.5 or something, I think, so they're very close, but that is a big issue for them. Then you've got, if there's a hard Brexit, does the pound go through the floor? I'm not a foreign exchange expert, I leave that to you people. But if it does, you would think a lot of Brits would think twice about flying overseas because it's just going to make their holidays more expensive. So there are lots and lots of different considerations there. If Brexit does turn into a bit of a tricky situation, it won't be helpful for them. I'd be very surprised. No, and I think, to be fair, their statement today was a bit of a holding pattern one, again, if you'll forgive the expression. It was, we've got all contingencies covered, so let's see.
Russ, thank you so much for your time.
Not at all.
That was Russ Mould, Investment Research Director at AJ Bell. I'm Victoria Scholar, and thank you for watching IGTV. See you very soon.